Good evening, everybody on the call, and hearty greeting from Virinchi in Hyderabad. I believe we released our numbers yesterday, and we have been able to put together a good presentation for today's session. We're possibly looking at both the quarterly results for the last quarter, but keep our discussions open more for the year ending 2017-18 period, and we'll possibly try to touch upon some of the directional momentum that we see going forward. Coming to the numbers quickly, we closed the last financial year with a revenue of 342 crores against the 288.6 crores last number, which is a revenue growth of around 18.6%. This revenue was followed with EBITDA growth from 65 crores earlier to 96.9 crores. We possibly talk about the drivers for both revenues and EBITDA and what's been the sectional contribution. But I'll possibly take a moment here to digest these two numbers and also explain the going narrative for the last financial year. Those who have been tracking Virinchi for the last, I would say, 4 to 5 years, at a CAGR level, this revenue translates to upwards of 25%. The EBITDA growth at around 42-43%. But more important, I think the last year was more for us to consolidate our position. When you typically grow 25-30% year on year, and that is possibly over a prolonged period of 4 to 5 years, there are times when you either chase revenue at the cost of EBITDA, or you chase the quality of revenue becomes a kind of a question over a period of time. And here we have undertaken strategic diversification. We have taken questions around India versus US business. We're talking about healthcare versus fintech businesses. And all of that put together, I think the last year is performance talks about a fairly good articulation of a stable state, steady business, which was a journey that we undertook around 4 to 5 years back. And this, while the revenue growth of 20% is something which we are anyway successfully presenting, we are also looking here into the quality of revenue, quality of margins, quality of EBITDA that we are seeing here. If you might possibly see our sectional revenues, both from the IT product, IT revenue, IT services, both of them have seen a significant improvement in terms of EBITDA as well as EBIT level, which actually creates more cash from the IT business in per se. And hospital, which was pretty much on a smaller base at starting on a very, very low occupancy in the financial year beginning 17-18, has now stabilized to a very good 5 to 6 quarter kind of performance, where we are talking about 20 plus, 22-23% kind of occupancy. Coming back to the numbers as we just spoke, so with the 96 crores EBITDA, which is around a 28.3% EBITDA margin on the current base of 340 crores, this EBITDA margin has significantly increased from the 20 to 22% that used to be there in the earlier period. Further, if you go down to the depreciation, which was again a huge component because of our hospital expansion, that is pretty much now in our expected lines of financial number, and hence the PAT per se has grown from 23.6 crores to 33 crores, which is like a 40% growth in PAT. Those who might recall the EPS, which was there last year, which was around 8.8, that has grown to a very healthy 11.7 this year, which again translates to 32% growth in EPS. While these growth numbers are important, not just as the revenue, but in terms of the structure of the P&L per se, we'll talk about balance sheet shortly, is also to give us a kind of a directional steady state or directional numbers that we will continue to chase going forward. Those who attended possibly our year back calls, or those who have been tracking us for some time, while these revenue growths have been jazzy and these revenue growths of 25-30%, in fact there are years in which we did 50% revenue growth, those were, there were people who came back saying that it was going too fast, too hot and all of that. I think this is the year where you can look back and say that yes, this company has been growing and a steady state kind of a growth. But more than the steady state growth, I think the structure around margins, structure around EBITDA from each of the verticals have started manifesting themselves for steady state income. And this is something which we would try to pursue going forward as we keep increasing our revenue per student, keep increasing our growth volumes at the top level. This cost structure, this profitability is something that we would continue to pursue. Coming to the segment part of it, I think this year also signifies a very strong milestone in terms of the strategic diversification that we had undertaken around 2.5 years back in terms of the physical hospital being there. Obviously, we have been doing this journey at least verbally for the last 4 years or so. So now we are talking about the IT business having a total revenue of 240 crores, while the healthcare business, 239.8 crores, while the healthcare business having a revenue upwards of 100, we are talking about a revenue of 101 crores. I would say a 100 crore mental barrier for a healthcare business is also meaningful for us, where it says that it's no longer an investment business, it's no longer a let's see what happens kind of business. Now this is something which is 30-35% of our top line, and which clearly completes the diversification piece that we are clear about, that the U.S. economy or the U.S.-based income, either from dollar side or changing governance policies that we are seeing with the change in the new government, we are reasonably shielded with that. And in fact, that is something which is best manifested both from our product and services business. While the services business saw a kind of a decline in revenue, the put together the revenue from the IT business has grown from 231 crores to 239.8 crores. This revenue growth is also translating to a better improvement in EBITDA and EBIT. So while the revenue growth may not be very significant because of the IT services growth has been slightly muted or has been eating upon the IT product business, but if you see the quality of EBITDA, the kind of, we are moving from a 52 crore IT EBITDA to 75 crore IT EBITDA. So that increase itself of EBITDA margin of 22% to 32%. So that is something which I was talking about, the quality of numbers, the quality of margin. In IT services in particular, what we have tried to ensure is that we do not pursue those numbers which pull our overall profitability down. And while the revenues have been offsetting here and there, but the quality of each customer, quality of each account, quality of the kind of relationships that we have maintained continue to be high value add. So the pieces that we are doing in the mobility side and analytics side have been generating better margins for us. The kind of pieces we are doing on offshore, onshore delivery has already been translating to better margins. The product business, the last analyst call that we did around a few weeks back, 6 weeks back, was more about specific business of Q-Fund. I think this business couldn't have generated a better, it has been an all-time good year for the last 12 to 14 months. The client that we won in January of 2017, that was QC Holdings, we had almost a full year of revenue through them. And now again, we are seeing a significant upside because of the cross-selling or the upselling done at Advance America. And those who might recall from the last conversation, just this particular new agreement or new contract gives us a visibility of close to 100 crore revenue, new revenue from Advance America alone. And while a lot of this revenue is front-loaded, but even if we take about a 5-year horizon, we are talking about a 20 crore of new revenue coming just from Q-Fund. And because these are revenues which are primarily around new license sales, etc., so this revenue adds to much better contribution, much better EBITDA, and hence the IT product business should continue to see better overall numbers, both at the revenue as well as EBITDA side of it. And it might be a good moment for us to reflect back on whatever 3 years back when we spoke about on Q-Fund in particular, where we are investing on the products, investing into the new version. We are investing into the new products and the new versions of this business. And those new investments got us the QC clients, has got us the upselling at Advance America. And while the sales cycle takes its own 6 months, but as we speak, the pipeline looks fairly interesting. So the net point is that from the U.S. perspective, whether Trump is good for many IT services business or not, but from our perspective, I think we have shielded ourselves very well on the revenue impact of that kind of a billing rate, etc. And the quality of revenue increasing because of the kind of customers we have put together. We have seen a very good improvement in the EBITDA side. Coming to the hospitals, obviously it started on a lower base of 50 crores, but I would say 100 crores was kind of annual revenue target that we are looking for. The number, I think it's kudos to the entire hospital healthcare team, which started out pretty much fresh and have reached that kind of a scale across all the three facilities. The other two facilities continue to improve on occupancy and improve on the profitability at around 50% occupancy now. The flagship facilities, which a lot of you guys have come down and visited, that has comfortably crossed the 20%, 22% kind of EBITDA margin as of occupancy as of 1st of April 2018. And talking about the EBITDA also, I think while the industry is having all sorts of healthcare news in terms of headwinds coming from regulators or existing listed companies not performing as per the market pieces. But I think for a young company like us, continuing to sustain that EBITDA margin of 20% year on year and generate a cumulative EBITDA of around 20 crores is something which continues to be commendable for the entire healthcare team. We increased our EBITDA base from 62 crores to 96 crores, and that gives us a fair amount of cushion both at the PAT level as well as EBIT level. Lastly, on this piece, when we are talking about the cash side of the business, depreciation obviously continues to be a large part of the kind of P&L structure we have taken. But if you just add the depreciation plus PAT between the 2 years, last year we had a cash generation of 46 crores. This year we have generated 66 crores PAT plus depreciation, which again is a 40-42% kind of growth in cash. I think that this counts as one of the better performance in terms of our financial management team, as well as I'll take a moment to commend each and every employee, partners, stakeholders, including investors like yourself, who have continued to show us the way as well as to support us in the entire journey here. And I'll possibly leave behind last thought coming in at a balance sheet level. The debts continue to be, we have actually reduced our overall debt because of the repayments that have been going on for the hospital. We are right now sitting with a debt of around 148 crores on the book. And if we are to just look into our current price today for whatever the markup that we are seeing, which was around 113 rupees, we are talking about a markup of 320. If we are to add these two of debt and markup, we are talking about a 460 crore EV on a 96 crore EBITDA, which translates to a 4.83 EV by EBITDA. With this kind of a scale, especially with the capex and no major cash guzzling business, no major risks on the cash flows, the US part is fairly well protected. We have spoken in detail in the last call. And the hospital business, whatever the first 2 years of uncertainty that you might anticipate, we are well past that stage. I believe this cash flows and this kind of growth and the profitability is something that we should be able to maintain as we go forward. I just hand over, so at this point of time, if we have any inputs, possibly we can just open the floor for questions.
Thank you very much. Ladies and gentlemen, we will now begin with the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Nikhil Bhargava from Zephyr Financial. Please go ahead.
Hello.
Yes, Mr. Nikhil, go ahead.
Sir, a couple of questions. First is, I want to know what is the hedging strategy at the company, because since the major pie is revenue is coming from software products, And what is the hedging strategy, and what is the number for the quarter and the year?
Yeah, it's like this, Mr. Nikhil. We've been hedging about roughly 50%, and that has worked out fairly well for us in the past. And you look at the current situation where the rupee has been depreciating, we're fairly well organized on that particular front.
Okay, so is it like out of software product revenue, out of 34 crores, you hedge around 50% exposure?
Yeah, software export is 100%. That's about roughly 239 crores.
Okay. I was just talking about the quarter, and that's the reason. So,
quarter, yeah, it is roughly okay. About.
And sir, what about the occupancy rate? I couldn't hear the figure properly. Is it 25% or something?
Yeah, currently, if you look at the current utilization in the flagship hospital, it's around 23%.
Okay.
Average the last 3-4 months, it's around 22%.
Okay, 22%. So you look. What's your view against on this occupancy rates? What rate you see the break even at any time, or can you tell me, discuss?
We are working towards improving the utilization levels where, we've shared this in the past with you. We have a 40-member strong marketing team with a mix of doctors and non-doctors who are always on the field. They're meeting the local practitioners, and they're also conducting these medical camps in a radius of 50 to 60 kilometers around Hyderabad. And we get regular patients from these activities. And in addition to that, we have a fairly active medical tourism program going on. So we have a good number of patients coming in from the African countries like Nigeria, Ghana, and from the Middle East. So we are strengthening these things as well. And in addition, we have the local patients coming in from the other parts of India. So with all these activities, we believe, we should be getting into a positive PBT this year for the healthcare business in the flagship hospital.
Okay, sir. Sir, on the Advanced America, the deal, I have just one small doubt. So you said the revenue is going to come in the next 5 quarters. So is it starting from Q1, or it's going to take time for the revenues to come in from the Advanced America?
We have revenues coming in from Q1.
Okay, from this Q1, so we can expect the revenues coming from there. Okay.
There will be improvement in the revenues in this quarter vis-a-vis the last quarter.
Okay, great, sir. And the interest payments, how is it? Is it on timely basis? When is the next interest payment, sir? Just want to know about the interest payments. Is it on timely manner going on, or any delays you witness or something again?
No, right now, the last 2 to 3 months, all the interest and principal repayments have been on time. Maybe if you were to go back, say, 5 months or 6 months back in time, there were a couple of days of delays. But otherwise, the last 3 months, there's been absolutely no delay. In fact, we've been paying a bit in advance right now.
Okay, great, sir. That's all from my side. Thanks a lot.
We have improved fairly right now. So that's not a constraint right now.
So then that should have a positive impact on the credit rating then?
Definitely. But the only issue is, people actually do the downgrade fairly fast. But to improve the rating, they take their own sweet time. So we are actually waiting for them to improve the rating. While we are doing whatever we can, which is in our control to improve the rating.
This is Vishal here. I'd just like to clarify, specifically on that particular down rating, if you see the entire statement, it actually talks about the entire delay was not on the ability to pay or a comment on our financial health. It was about a 2-day delay in the repayment. And that was just coming because of the, more about the RBI norms about declaring those delays. So I think this is something which was a episodic thing that came and moved fast. And for the last 4-5 months, 3-4 months, like what MBS was explaining, I think we have been fairly diligent on that.
Okay, sir. So what's the current rate of interest, sir? Like close to 8%?
On the 68 crore of original borrowing that we have in the books of Virinchi Healthcare Private Limited, the current rate of interest is 12.2%.
Okay, sir.
And on the equipment funding, which is sitting in the books of Virinchi Limited, the rate of interest is 10.5. So the blended interest rate should be around 11.5 or so.
Okay, sir. Thank you, sir. That's all from my side. Thanks a lot.
Thank you. We take the next question from the line of Harsha from Dimensional Securities. Please go ahead.
Good evening, sir, and congratulations for a good set of number. So, just following up on the interest part, for this year, I'm seeing that your interest expense is around 18 crore on a debt of around 120 crore. So, it roughly comes to around 16-17%. And you just mentioned that the blended rate is close to 10.5%. So, am I missing something here?
No, the average debt for the last year is around 150 crore. It's not 120 crore.
No, because I'm seeing on in FY17 it was 118 crore and now it's 108 crores.
Yeah, that's the term debt.
So in between you had availed short-term borrowings?
Yes.
And so what was the requirement for the short-term debt?
That's primarily for to take care of
our CFO, Ms. Shanti, is here. She'll just explain in a moment.
Yeah. No, the purpose for asking the question is we have had a good cash flow generation, the kind of EBITDA which we have grown. So I was just interested in knowing why did we avail for the short-term borrowing.
Short-term borrowings includes 12 months term loan repayment plus working capital debt. As well as part of the term loan which is payable in the next 12 months is also included in the short-term borrowing.
So the entire short-term borrowing has been paid as of March 18?
Short-term borrowing includes working capital that will continue in the books and based on the current asset ratio and there is 12 months repayment based on the...
So because I'm not able to see the same on your balance sheet. The borrowings cell is empty.
Okay.
So where do you classify the
I have two components here. You are seeing a number 108, which is in the long-term borrowing.
Correct.
And there is a number 39.67, which is in the current liability. Correct?
Okay, that's against trade payable.
Yeah, no, okay. Now the typo, got you. I'm so sorry. The typo, good that you identified. Actually, all of that has shifted a row below. I'm sorry.
Okay, so that should be borrowings. 39.6 crores.
39.67 is on just a row below is the question.
Okay. Now it makes sense.
The total debt, average debt should be 148, on which if you see our cost of capital, you got us there.
So what is the interest rate we are paying for the short-term borrowing?
13% for the working capital.
The short-term borrowing will be at 13%, mostly on the working capital, and as we, with the kind of increase in revenue, that is something that will stay in the books as we go forward.
Okay, fair enough. And another question, again relating to the working capital. So our trade receivables and short-term loans and advances have almost doubled, while our revenue has grown by say 20-25%. But these are the two components which have shown sharp growth, and this is where our capital is getting blocked. So can you elaborate on the same?
The receivables are on average about 80 days. The duration is about roughly 80 days. That's the reason you find that there is an increase in the receivable. Because what happens is, in the past, we had receivables mostly from the information technology. So right now we have a mix of both information technology and healthcare. And in the case of healthcare, the receivables are slightly longer for the patients that we treat who come in from the government-run insurance scheme. In fact, the realization period actually runs into something like 6 months. So that's the reason the average realization time has gone up.
In fact, to substantiate that, last year when at a 50 crore hospital revenue base, we had the average receivable was around 1 crore. Now we are talking about that number going to 7 to 8 crores on a base of 100 crores. So it's not just the revenue has doubled because of the kind of revenue, or I would say, more and more insurance companies that we are adding up with, or more non-cash patients that come in. It has become sizable. But again, the point I would say that at least from the revenue cycle management as well as from our cost of working capital questions, this is something which is in line with the healthcare industry per se. So if we had to look into the average collection, say from a completely government-run scheme like Arogya Shri or CGHS, we are doing possibly at much better than whatever the industry would have speaking it. So on the hospital collection side, I think we do not have yellow flag at this stage.
So of the 100 crore revenue which we did in hospital, how much would be from these schemes?
Okay, I think I would give that kind of a quarterly view, because what we started the year with and what we ended with the year with are two different places. So at a weighted average level, possibly now we are talking about close to 10 to 15% revenue, coming in from at a weighted average level, coming from corporates as well as insurance, government, and all. But if at this stage or possibly going forward, this will stabilize on a weighted average of 25 to 30%. So when we speak at similar time, we'll be looking at 30% of my hospital revenue, which would be obviously growing much faster. At that base, we'll be seeing 30% of our revenue coming from government or insurance or non-cash source.
So, correct. So, if the revenue from the scheme-related patient is only 15%, then I don't think it should make much of a difference on your payables, because for other 85% of your patients, they would be more or less paying in line with the industry, like 25-30 days. That's what the credit period usually is.
No, there are two components. When I say cash, there are cash plus insurance. People like you and I, when we go to the hospital, I'll flash a card and do a cashless. That is also sitting in that 85% number.
Even the TPA, the regular TPA related payments, they take on an average about 2 months to realize. 45 to 60 days, yeah.
Okay,
so it's not that we get it in about 15 to 20 days, but even the regular insurance amounts, we take about, 2 months, 60 days to realize.
Okay.
Is in line with the healthcare industry in general.
Industry practice.
Yeah, fair enough. And so another question in the IT product, the margins have increased sharply as you ran through. So can we take it as a sustainable base? The margin which you clocked in this year?
Yes, we would definitely. That's the kind of target number that we will be pursuing going forward.
Okay, and last question is on the service part, where we saw a decline of around 10-odd%. So how do we see this segment shaping up going ahead?
So if you see, in fact, in my opening conversation, I made the mention about the IT services case of business. While there is a revenue dip primarily because of the customer segment or those segments which are not really profitable, we chose to move out of those contracts, because they're not, unlike IT products which are like 7 years, 8 year contracts. We do not here. These are projects. You do 3 months, 6 months, 12 months projects. So what we have tried to focus, especially because of the kind of industry and what are the prevailing sentiment in the US is, it is very easy to keep chasing revenues and keep bleeding money there. So what we have tried to ensure in the last 12 months is that our EBIT improves. Obviously, EBITDA improves and hence EBIT improves. At the same time, we get those projects which are typically high on the value chain. So going forward, you'd see more of analytics, more of mobility, more of cloud projects, and less of IT, SAP implementation or Oracle implementation, where you get just a billing rate kind of a project. Secondly, you would also see us doing more of projects delivered out of India, which again gives us better margin, simply because those who are there in the US have gone expensive. There's also kind of a supply-demand mismatch that is going on because of the visa uncertainty in the US. So to deliver projects or to structure projects which are primarily on-site are not a very good idea in this kind of a sentiment or this kind of environment right now. So we may possibly, whatever the revenue decline that we saw, despite the revenue decline, if we are seeing an increase in EBIT and EBITDA, that is something which I would like us to take down forward. And this is something which will continue to happen as we go forward. Exact revenue growth or what is the kind of further on this space, how fast can we grow? I think the pipelines are healthy. The sales team that is there in the US as well as working out of India, I think they are as optimistic as possibly they should be at this stage of the year. Possibly, more in the quarter of September to December, where we'll have a better visibility of how the revenues go forward. But at this point of time, I'm not too worried on the revenues. I'm very, very confident on the kind of margins that we should be able to generate.
Okay. And just the last question, if I can slip in. You mentioned, so in this year you upscaled one of your product with Advanced America. So you mentioned that, mentioned something about 20 crore incremental revenue every year and 100 crore revenue which will be front loaded. Actually, I didn't get that part. So how exactly will you be booking those revenues?
Okay. The last analyst call, we had kind of a slightly detailed discussion, so I was presuming that the numbers are available. But just to clarify, the new revenue because of the upselling at Advanced America, primarily it is the new product license that we have sold. That new revenue translates to 100 crore of new revenue over 5-year period. Even if you average it out, it is at 20 crore new revenue year on year.
Oh.
While the contract has been such that because they are license income and all, so it should be by definition be front loaded, but a 20 crore is the safest assumption that we can take for the next 5 years. The contract is on an auto renewal, and hence in the 5th year means unless, Advanced America has been with us since close to 11 years. So there is a fair amount of stickiness, and this particular client, has now pretty much got the entire lock, stock and barrel with us on Q-Fund. Earlier they were having a small in-house team. They have kind of removed the in-house team. They are no longer looking to invest into any alternate. So this is kind of a relationship which is almost, tight for the next 5 years, a visible future. Means this kind of contracts can easily go to 10, 12 years as we speak. That is number one. Second, this 5 years or 20 crores of new revenue we are talking about does not have a huge cost component in terms of, delivery side, because these are new licenses or at best a bit of hardware purchase here and there. But if somebody were to have an on-the-price license of Facebook and then there are 50 more users coming onto Facebook, it doesn't cost Facebook so much. So similar kind. So the good part of this is in the last analyst call we mentioned that this may translate to almost 15 crores of new EBITDA. So 20 crores of new revenue should translate to 15 crores of new EBITDA. Again, this is not an EBITDA margin baseline, but this client should generate that kind of a incremental EBITDA. You do a 30% tax and then possibly you're talking about 10 crore of new PAT just from this Advanced America client. So what is also a so what for all of us going back is that while we are seeing IT products business already doing well, I have a complete visibility of 20 crores, everything being the same, at least that 20 crore new revenue, 15 crore new EBITDA, and hence 10 crore of new PAT should be coming out if we were to do nothing now. There are, upselling going on in existing clients. There are each of our clients Advanced America revenue and EBITDA.
Okay, and the receivable days will be what, 45, 60 days for this business also? This IT product base?
Yeah, IT products typically 45 days is a safe assumption. Barring a couple of collection issues here and there, 45 days is a safe assumption for all collections.
Okay, and the second question on this IT services, since our revenue have declined, we have exited some loss-making projects. So what has been the utilization currently on this business?
Okay, there are 3 components to our IT services when we say. Obviously, the on-site part of it is like typically the bench time in the US would never exceed like 35 days, maximum 40 days is for an entire 12-month period. So on-site utilization has never been a problem. The offshore team is a kind of, while the bench might be slightly higher, but that gives me the ability to deliver those projects. And because, Kalpesh just spoke about the V-Card business and the other products that we are investing, it may not be a very black and white definition of who in India working for IT services is on bench. They keep investing into new products for mobility, new products for analytics. We are doing some very, very interesting stuff in AI. We are doing some speech-to-text, doing some image recognition, video recognition pieces. So those are the investments on which these people are there. But billable revenue, if you talk about, we are around industry lines in offshore, and we are very good on the onshore side of it. There's no reason why I will keep an expensive resource in the US on bench longer than anything that's needed.
Okay, and so what has been our attrition rate for this IT services?
US US attrition has been hardly any, means we are not revenue-wise not anything. Offshore we are getting a number around 5 to 8%.
Okay, and so what will be our wage revision cycle? Normally, what cycle we follow?
September to September, 12 months.
Okay, September. And sir, it is possible to share some more operational metrics for hospital, like average revenue per occupied bed, average length of stay. So is it possible to share?
Not only that we can share, we'll possibly put together a simple MIS board to look for everybody. Before I go there, I just wanted us to also take that small step for where this last 12 months were coming in. I think that Kalpesh clearly mentioned it for us. While on an asset-light basis, whatever kind of EBITDA margins and the occupancy that we have seen is good, but we continue to pursue occupancy as our first metric. While ALOS or the ARPOBs of our businesses, typically because of predominantly high cash business, are much above the industry standards. Because I'm talking about for the flagship hospital, the ARPOBs would go even for 27 to 30,000 rupees per day per bed. But that's not something that I would like you to take home that, okay, this is what's the typical end state numbers we'll see. Right now we are chasing revenues, we are getting more cash patients, more of super specialty patients. Right now we are doing cardiac, ortho, a lot of neuro and nephrology patients. So these are typically, you can get as much as like 1 lakh rupees per bed from those patients. But I think these metrics of ARPOB, ALOS get more relevant once you start hitting that 40 to 50% occupancy. At this stage, so far, I am doing a good job in building the patients and ensuring that we have a healthy EBITDA margin compared to the industry. We are doing reasonably good. I think let us continue to focus on revenues and occupancy this year. And while I have nothing to hide on those numbers, as I said, we'll be publishing with the MIS report shortly. I think you should continue to ask or continue to expect more discussions on revenue sources, where are the patients coming from, how is our medical tourism doing, what kind of new doctors are coming in. Incidentally, we kind of doubled our doctor pool over the last 14 to 15 months. So when we started in April 2017 to where we are now talking about 180, 190 doctors, while we are like 70, 80 doctors at that time. So obviously with increasing occupancy, more doctors, more of business development activities, that is something which we will intend to continue doing for the next 12 months for this flagship hospital.
And so is it possible to share inpatient versus outpatient mix at least?
As of now, the inpatient is around 80% and the outpatient is 20%.
Revenue-wise.
Okay. And EBITDA for the hospital division for the whole year?
Or 19% roughly.
Okay, 19% on approximate 19 crores.
No, it's sorry, I was wrong. So it's 101 crore of hospital revenue and 20. Just a second. 20 crores of EBITDA. So it's 19 change. The revenue is 101 and EBITDA is 20 crores.
Right. And so final question on capex for FY19 or in FY20.
There are a couple of initiatives that we are doing right now. One is we are working on the economy block. Economy block, we are doing it in 2 phases. The first phase of 50 beds will be operational in about a month and a half from now. So for that, we are incurring about roughly 5 to 7 crore. We will be doing that from our internal accruals right now. And we have a plan of starting work on the oncology block in the next, 5 months or so. The oncology block, the project cost will be roughly about 40 crore. That again, we will do it through a mix of our own accruals and, supplier credit and some borrowings from the banks.
Okay. And nothing on ITPs?
IT capex would be, pretty much similar to what we are seeing year on year. There will be no major numbers that we are seeing. I told you about, maybe a bit more servers, etc., that will be purchased for the new licenses. But no other items should be coming on the capex side for the IT.
Okay, sir. Thanks a lot and all the best for the future.
Thank you.
Thank you. Before we take the next question, a reminder to the participants, if you have a question, you may press star and 1 on your touchtone telephone. We take the next question from the line of Mayank Babla from Dalal & Broacha. Please go ahead.
Good evening, sir. Congratulations on a great set of numbers. Just a few questions I had. First was, so there was plans of launching a healthcare integration app. I believe last year we had interacted.
Yes.
Any updates on the same? It was about to get launched in March of 2018. So could you just throw some color on that?
So the product is called V23, and we have maintained that this is in the June quarter. So this is the quarter where we are talking about. So this is related to the projects with the UP government as well as those associated businesses. The good news is the product is pretty much on track and has been completed through UAT and ready for rollout as per the timelines which we have set across in the project. So the June to July kind of period is a time in which it should be available to the UP government users. Beyond the UP government, we do want to do it in other parts, especially in our own catchment areas. But these are typically retail businesses. These are businesses which you do possibly from the apps where you would, more like the Practos and the Call-Ls of the world.
Okay.
And that requires its own set of investments in terms of marketing and go-to-market part of it. While the team is stabilizing the product and the UP project is something that we are using it to get that amount of traction. And here in Hyderabad, there is a bunch of ecosystem doctors and providers we have already kind of lined up. The commercial launch of V23 would kind of be, succeeding the completion of the UP rollout. So at this point of time, all I may just leave behind is a message that for V23, revenues is something that we shouldn't be counting much for this financial year. But the number of installs should keep growing up. And once we have a certain amount of critical mass, then the necessary amount of marketing effort or marketing push would go behind those products to generate the revenues. So at this point of time, we'll keep the team updated about how the Uttar Pradesh rollout goes around as per the timeline. As of now, there is no slippage on the timelines that we had agreed to the Uttar Pradesh government.
Okay. So, and second, thank you for that. And the second question was, although you've explained a lot on margin improvement in the IT product space, could you categorically give a breakup of what has caused this improvement in the margins? Has it been realizations or improvement in utilization, or could you just throw some light on that?
So, okay, let us spend a moment on the business drivers for IT business. So most of these clients are sticky clients, have been with us, at least the large guys which we are talking about, average of 7 to 8 years. And our incremental cost to serve these clients keep coming down with every passing year. While we keep getting custom work, we keep getting service work. In the earlier calls we have spoken about, it's not just the license or the SaaS-based income. We keep getting the service work from these clients. Over a period of time, our delta effort to keep a client happy or to our delta effort to keep their systems live and going keeps coming down. So that maturity is something which allows us to, a specific example, let's say something like an NCP Finance. Advanced America, we have been talking for a lot of time. So NCP Finance, earlier I may be needing a 40-people team to service this client. Over a period of time, offshore, I may be able to reduce that. For that work on maybe 28, 30 people is required. But what is interestingly happening is NCP will start a new product or new module or a new geography for which additionally 25 people are coming in. So that new revenue will generate its own set of profitability, while the existing businesses over a period of time will not require so much of variable costs. As in the case of Advanced America, theoretically even 75%, 80% EBITDA is possible because it's exactly what you see in a product business. You shouldn't be spending 40, 50, even 20% of your salary should not be going to serve an existing client. So most of the margin improvement, if you see, is obviously we have tried to cut down costs, rationalize teams, reduce flab that you could do, but those are things which you do on a regular business. these clients over a period of time will continue to improve our profitability as we move forward, except when we invest in new products, except when we come up with new mobility solution, new analytics. But those investments generate new revenue as we go forward.
Okay. And sir, last question was that in the previous question you had given the ARPOB parameter for the hospital business. Could you please repeat that? I couldn't get it.
ARPOB is varying between 26 to 28,000 right now. Like Vishal has mentioned a while ago, we probably cannot take this as a sort of a norm going forward, because when this capacity utilization stabilizes, say, beyond 40%, the ARPOBs can probably stabilize from somewhere 25,000 to 28,000. Right now, our ARPOBs are on the higher side because we have a lot of international patients coming in, and the realization per patient is very good because of the therapeutic mix that is there right now.
Correct.
But as the capacity utilizations go up, then we will also have other therapeutic mix coming into picture, and the ARPOB could actually stabilize around 25 to 26,000, which would be the norm in the industry. Right now, we are there on the higher side.
Correct. Okay, sir. That's all from my side. Thank you so much.
Thank you. We take the next question from the line of Pramod Yelapo, individual investor. Please go ahead.
Hello, sir. Thanks for reporting a very good set of numbers. So I'm just interested in knowing what is the edge that we are building with respect to the medical tourism, with respect to other hospitals that we have in India.
So, medical tourism, while it has been explored for close to, I would say, 20 years, it's only in the last 8-10 years these have become sizable part of hospital occupancy. Having a few faces is one good part, but if you say that if 8%, 10%, 15% of your revenue is coming on the dollar income, obviously that becomes a clear strategy which makes things more streamlined. Like everybody else, we are focusing more on MENA market, Middle East and North Africa. Incidentally, in fact, one of our very senior doctor is based out of Nigeria, so he kind of shuffles there. He's a sales doctor. It's not a delivery doctor that we are talking about. So a sales guy who is actually an MBBS is based out of Nigeria, almost like 20 days a month. And there we have found a group of doctors, which are like 100 doctor chain, who are committing their practice to us. So what we are doing even going forward are two components. One, work with the doctor pool in those countries. In Nigeria, in Tanzania, in Kenya, we are doing reasonably good. And then a bit of Middle East, not much in UAE, but Qatar, Oman, those areas we have got some good head start already. So we'll continue to invest in those places where rather than talking to patients directly, we are talking to those doctors, those influencers. That is one. Second, because of our technology piece, a lot of these doctors are able to deliver video consultation, mobility, a lot of patient continuity of care solutions. I'll spend a moment here because what happens is a lot of these patients might be screened in Nigeria and they may just drop off. They do not have, either they will go somewhere and you will not know where they have come in, or they will come to Hyderabad or Bombay and then they'll go to the other hospitals. Because of the technology flow, at least we are able to maintain that continuity with the patient. We know who's the patient. Patient knows our doctor, and hence the drop-off ratios are very, very good, very, very low already. Number two, we are facilitating those doctors in Nigeria to use our technology to serve the patients. So either for cross-consultation, they are doing a bunch of second opinions there, and hence this technology piece allows us to create almost an equivalent of a channel partner network in those countries. So despite having a low feet on street in these countries, using technology and channel partners, we are creating good funnel, very predictable funnel. What is happening is not lumpy, suddenly you go to a medical college and get 20 patients. No, that's not going on. Almost on a weekly basis, we are seeing a continuous flow of patients. That makes that kind of high ARPOB business predictable for us.
Yeah, that makes sense, sir. And I hear, I'm based out of Hyderabad, so I hear that Virinchi is able to attract very experienced doctors in their respective fields. And like now, what are the plans to retain them, sir, for a longer duration so that they can grow and it will be a win-win for both the hospital as well as the doctors as well?
First of all, coming from your Hyderabad endorsement, nothing could sound better, because I think that is the message, or that's the kind of target words that we are looking here in the city also. Three things have happened well for us. One, obviously being a city center, 90% of the senior doctors have built their practice within that 5 kilometer, 10 kilometer radius. So their old patients or, their reputation is in the city center, not in Gachibowli or the new upcoming part of it, because they have to go and start up fresh there. So for them it becomes a kind of a natural choice that if they can do their practice in a good facility, good location here, makes sense. Second part, which I think from day one, even before we started the hospital, that two vertical organogram that we have maintained, that the business side is led by different people, while the clinical side is led by an experienced medical director. Our medical director, Dr. Murthy himself, is an entrepreneur. So that kind of a thought process has allowed us to give the necessary freedom to the doctors. There's a lot of lip service that goes saying that let the doctor, is important and all. But at our side, the fact that none of the doctors are at the board level of Virinchi or Virinchi Hospital, we come with that humility saying that let the doctor be the best judge of how to run his business. And in which case, we have given them the freedom, we have given them the decisions, and not one of our sales guys ever goes to a doctor saying that, sir, what is the revenue target, or is my OPD nahi aaya, those kind of discussions. I think that is something which we have kind of maintained and continue to sustain over the last, I would say, 2.5 years of interaction. And the proof of the pudding is so far, when we are talking about 200 doctors, or say even 80, 90 senior doctors which have been with us for 2 years, we are seeing an attrition of 2-3 doctors so far. One of them went to Dubai, other went for a higher education, the other person wanted to do something in pediatrics, which is right now an upcoming specialty for us. So the point I'm making here is that while it is one thing good to say that I will pay the star doctors and get the best, they will bring the money for us, bring the patient for us. From day one, we have tried to ensure that we are sensitive to the doctors, we pay them well, give them a fixed salary kind of a structure, but don't load them into marketing or sales kind of a role. Of course, I market my doctors. I say I have the best doctors in the town, but I do not put the onus of getting the patient from the doctor, and by doing which, a lot of doctors are gravitating to us. A lot of very good doctors who have been watching us for the last 2 years are now coming back and saying that they want to join us in the city center. And I think that is something which we intend to continue doing it.
That is encouraging, sir. And are there any plans on the future hospitals? I heard that Virinchi has an aggressive target of setting up 5,000 beds by year 2022. And I read places like Vijayawada and all as prospective places. So what are the plans on that? Is it possible for you to share a bit on that?
We have no reason right now to revise that 5,000 beds for 2022 part of it. But I think the last year was the kind of a litmus on our commitment that if this hospital was not doing well, either the revenues are, not picked up or my EBITDA was bad, then that kind of a growth numbers would have to be either revised or you have to think again on what you want to do. So I think that where we stand after the last 12 months, I think we are, pretty much on with whatever we have spoken about. What happens in this quarter, what happens in this financial year, I think it's a bit too early for us to give any direction. But that vision of 5,000 beds is something that we continue to, pursue. And exact details, I think the moment we have something more tangible to share, we'll be definitely coming back to you guys.
We are looking at both the medically underserved markets as well as the medically developed markets. Like you rightly said, we are looking at places like Vijayawada, we are looking at places like Vizag, and we are also looking at medically underserved markets like, Odisha, Chhattisgarh, and those kinds of places. So we are trying to balance these in terms of a couple of things. If we have to go to a medically underserved market, there is a requirement, but availability of the doctors would be an issue. So we are just trying to look at all these parameters and then take the next step of expanding.
Thank you, sir.
I think whatever the process that is required to expand, we are in that process, but I don't think we have anything meaningful to share at this stage. But obviously, as soon as something comes on the table, and I think it's not only about location, it's about how do you arrange the fund sources, how do you get the doctors, how do you build the synergies, who are the people who will go and run the show. So whatever the processes for those organizational growth, we are onto it.
Exactly, sir. And given that hospitals are high real estate intensive businesses, and which would need a lot of capex investments initially. So, are you looking at some asset-light model? I think it's too early to talk. But
anyways, I think what you have seen here, and if you have visited our location, you have seen possibly we have done a reasonably good job of our facility. So, we are not here to undercut our quality of treatment, but a model where we have delivered like 40 lakhs per bed kind of hospital. Without the land and the building, we don't want to build a very heavy balance sheet behind the hospital. I think this business or this flagship hospital forms a reasonable amount of template of how we want to do the next set of hospitals.
We are, interested in looking at the asset-light model, and we would continue looking at asset-light model. And wherever opportunities present in terms of acquisition, we are open to acquisitions as well.
Thank you, sir. Thanks for sharing the details.
Thank you. Well, as there are no further questions, I would now like to hand the conference over to the management for their closing comments.
Thanks a lot, everybody who spent the time this evening in this busy earnings season. And I think those who tracked us for the last few years, I think these quarters of these earning calls are a very strong, a good place to come and talk that, okay, 3 years back when we were talking about we'll build a hospital, we will make it financially, independent and stand on its feet. I think those things are now visible. Those things are manifested well. And in terms of overall business perspective, I think whether we talk about revenue, whether we talk about EBITDA margin, whether we talk about protection of that EBITDA margin, whether we talk about U.S. visibility of revenue, hospitals doing well. I think all of those operating parameters we are doing very comfortable at this stage. But I think at a DNA level, we continue to be entrepreneurs. We continue to think that this is something which was launching pad for a much bigger play as we would like to do. And in that kind of a direction as we go forward, at least at a structure level, my revenue momentum, my margins, if we are able to protect, I think we are up for a better growth start going forward. And as you are aware, whether it's V-Card, V23, in the US, we are doing quite a few new investments. So these investments will continue to help us change orbits, will continue to push us into new, possibly new territories of growth and, value for all of us. And in that perspective, whether we say at this stage, what is my current, EBITDA, what's my current markup, what is current my book values, I think all of these are directional numbers rather than, at this point of time, this is where we are and we are at a steady state. Actually, it's not. We have continued to be a high-growing, high-performing business as we are there. Lastly, I would thank not only my team here, my employees, but each one of you who have invested and have recommended and gone ahead and stuck your neck out saying that Virinchi is a professionally managed good company. We promise to continue to live, on your expectations. Thanks a lot.